Welcome to the University of San Francisco, and welcome to the University of San Francisco Nobel Lecture Series. My name is Jeff Silk. I'm a graduate of the university. I am part of the Board of Trustees here at the university, and I'm also the board chair of our Academic Affairs Committee. My wife, Naomi and I founded the University of San Francisco Investment Institute. And under the Investment Institute here, we have this Nobel Prize series. We also have a student investment club. We have created a financial literacy program for the underserved areas of San Francisco. And we created an investment minor. The University of San Francisco will be one of the only places in the country that you could get a minor in investing that is open up to any major. So if you're an economics major or a sociology major or a business major, you'll be able to get an investment minor here at the University of San Francisco. And really, our goal is to prepare students for when they graduate, if they choose to get a job in the investment industry, that they are ready to go. Where is Dean Otko? I saw Dean a second ago, but I do want to thank Dean Otko, who is the Dean of the School of Management here, and she has been so helpful and so supportive of the Investment Minor, the Investment Institute, the Nobel Prize Speaker Series. I also want to introduce, but I also want to thank Professor Ludwig Chincarini, who is going to be the director of the Investment Institute and basically created this Nobel Prize Speaker Series that we put together, which I also think is one of a kind. And Professor Chincarini teaches finance here, teaches investments here, works so very hard for the university, and I'm so honored to have him be the director of the Silk Investment Institute. So with all that being said, I would like to introduce Professor Chincarini.
Thank you, Jeff. Always so kind. Good evening, ladies and gentlemen. The structure tonight will be a 45-minute, roughly, lecture, and then we'll have a 30 to 35-minute Q&A, just so you can prepare yourselves. We will do a small break in between so you can stretch and things of that sort. I'd like to thank also Dean Otko, as Jeff did, and especially Linda Wong, who helped us with organizing all this, and the students that volunteered, as well as Sam Bethel, that helped us with other things. But most importantly, I want to thank Jeff Silk, Naomi Silk, and the Silk family for continuing to contribute to this university and to the greater wide community. It's truly fantastic what they're doing. And if you could turn on... If you could also turn off your cell phones, we always forget that. Okay, the year is 1982. Our guest speaker published a paper entitled Autoregressive Conditional Heteroscedasticity with Estimates of Variance of United Kingdom Inflation. Now, if you remember Mel Brooks, what in the wide world of economics is going on in here? So, conveniently, though, our guest speaker and others changed these names to Arch, Garch, and Vec, and those are easier to pronounce. And they've had a large impact on the investment and finance community. The idea is simple. Rather than assume that the risk of an asset is constant, the risk of an asset depends on its own previous values of risks. That is, volatility today depends on volatility yesterday. Investors and practitioners thought that this may have existed, But our guest speaker won the Nobel Prize for formalizing the econometrics of this process. While Engle introduced the term arch, his student introduced the term garch, and another one of his students introduced the term vec. These models are well known in investment circles. He was awarded the Nobel Prize in Economic Sciences in 2003, along with Clive Granger. By the way, a little fact where I'm going to compliment myself. In those days, I used to predict the Nobel Prize, and that year I predicted Clive Granger, Rob Engle, and Jerry Hausman. So I got 2 of 3. Rob is currently the Michael Armelino Professor of Finance at the NYU Stern School of Business. He is also the co-director of the NYU Stern Volatility and Risk Institute. He obtained his BA in physics from Williams College and his PhD in economics from Cornell University. Although our guest speaker is a serious econometrician, he has a lighter side. He has competed in ice dancing all his life. So if anyone wants an ice dancing lesson, that might be later. Today, he will discuss his relatively new work on termination risk due to climate changes. That is, the companies that are subject to climate risk might underinvest, thereby ironically improving their stock returns at the expense of sustainable companies. Could you give a please warm welcome for Dr. Robert Engle.
Well, thank you all. It's great to meet some of you, and I hope we have a chance to talk again this evening. It's a real pleasure to be here. I've spent a long time in San Diego, but I have never been on the campus before, and it's a beautiful campus. So it's a pleasure to be here. I've also spent a lot of time in New York, so we're back and forth now, and it's very nice to be with you tonight. There we go. What is this for? So how many times have I been asked that? And the first time I got asked this, it took me about an hour to answer the question, and I needed a blackboard. But now I can do it in one sentence. It's a statistical model used to predict risk in financial markets. Risk. Risk is something we all kind of understand. And the idea that you can predict risk is kind of useful. I mean, we know that in financial markets there are risks all the time. So having a quantitative way to do that is pretty useful. And it turned out to be a good ticket for the Nobel Prize. And this is, of course, a picture of Alfred Nobel, who didn't know anything about economics and did not actually create a prize for economics, but the Swedish central bank said, you know, we're willing to join with the Nobel Foundation to give a Nobel Prize in economics, which started in 69? Okay. With anyway, the first U.S. Nobel Prize winner was the next year, which was Paul Samuelson, and it's been given ever since. And so I was lucky to receive this in 2003, and that's now 20 years ago. Just a little over 20 years since we went to Stockholm, and the king, we all had dressed in tails and a tie, white tie and tails, and the king gives the award, and then you're supposed to stay up all night dancing to ABBA, and it's quite an event. Anyway, what do we do with volatility? Well, one thing if we have quantitative measures, we can sort of see where it is. And I'm going to show you off and on tonight pictures from the website, which is called VLab, or Volatility Laboratory. It's part of our institute, the Volatility and Risk Institute, and this is one of the introductory pictures, which kind of tells you, well, in what country is the stock market today the most volatile? This gets updated every day. So this is a picture of what the Garch model, the best Garch model that we can think of, says the volatility is going to be for Turkey and China and South Africa. And when we look in the bottom of it, it tells you which currencies are the most volatile. And it's South African rand is the highest, and then it moves down and so forth. On the right-hand side, it's sort of broad indices. So it's kind of an average of volatilities of healthcare stocks traded in different countries around the world. And that's the most volatile industry, and technology is second, and so forth. And the bottom is for commodities. So this is just a quick snapshot of sort of what's going on today. And another quick snapshot is this map of the world, which is color-coded, so we don't have to think too hard about it. But basically, where it's green, the volatility is low. Where it's red, the volatility is high. And it's a way of keeping track of where things are happening. And volatility is a way of measuring how important the things are that are happening, at least measuring it from the point of view of the financial markets. So how does that relate to climate risk? Well, here's the same word, risk. So we think of climate risk as being just another type of risk. Science actually has a lot of theories about how the world is warming, but in fact, to measure the risk to us, we need also economics, and we need policy, and we need all the connections between the globe getting warmer and the sea level rising and all these things, and what it does to us. What does it do to our income? What does it do to our investment portfolios and that sort of thing? So science tells us what maybe might be the drivers in the long run, but to understand it, we need to use economics. And we all have seen a lot of events, and typically recent events, which show that this is really happening. But the reason it's so important is because we think that what we're seeing is only the beginning of what is likely to be a good bit worse if things progress as science kind of says it's going to happen. And so when we talk about the financial risks due to climate change, we're asking, what do we see today that reflects people's concerns about the distant future? That asset prices reflect what we know and what we think is going to happen in the future. It's what we know has happened recently helps us form those expectations, but the expectations have a whole lot of other features in them that allow us to compress the future back to today. And it's these asset prices which direct capital to different things. And when we talk about whether we're investing enough in trying to, fix the environment and so forth, it's these asset prices we see today that regulate that. So just if you don't really think that expectations have so much to do with what you see today, turns out Tesla stock is, I just looked it up, it's trading for roughly 60 times its current earnings, whereas GM is less than 5 times its current earnings. The investors really think the future is a lot longer and brighter for Tesla than for GM. They might be right, they might be wrong. This is just what investors' expectations do. Okay, so we're talking about risk. A risk is a bad thing that could happen. If it happens in the distant future, we call it a long-run risk, and it's obvious that that's the sort of thing we're talking about with climate change. It's not that we know what's going to happen, it's there's a risk that it will happen, and we have to prepare ourselves in whatever way we can for the risks that we're willing to take, and maybe risks that we're not willing to take, we have to figure out how to not be exposed to them. What are the risks in the future? Well, obviously there are storms that come in, and the storms are getting worse than they used to be, and we have droughts and we have wildfires and stuff like that. But some of the other really important risks have to do with what the government does. Is the government really going to take an active role in fixing this, or is the government going to say, well, the next administration can deal with it, or I don't really believe it's true, or something like that. So obviously, when we think about the risks of climate change, we might think that the science is really what's going on, but politics is a big part of these risks too, and it really means that we can't talk about this just as a science project. We have to talk about it as a full economic system. Okay, so I'm going to give you an example. And I want you to think about this because I think it motivates what I'm going to talk about tonight. Suppose you're the owner of a beachfront luxury hotel. Beautiful hotel right on the beach. But you know that the sea level is rising. And you know that at some point, maybe a decade away, maybe 2 decades, maybe less, this is going to get washed away. How do you manage that hotel? Well, you might try to sell it. You better sell it before it gets washed away. But the person that's going to buy it probably knows the sea levels are rising too. So it's not going to sell for nearly as much as maybe you paid for it originally. Well, should you do a remodel that you've been thinking about? The answer is probably if this remodel has a payback period, which is fairly long compared to when you think the hotel might actually be destroyed, you shouldn't do it. So one of the natural things to do when you're managing an asset like this hotel is to reduce your investment in it. And one of the things that makes happen is, of course, you save money by not investing. You're still going to get the rent from the people that visit, and yet you don't have to pay so much. So your profits actually go up. It might be that the other hotels on the same beach face the same incentives, and they withhold their investment. So in fact, there might be a shift in the supply curve inward to lower supply, which makes the price go up. Because if people still want to buy a luxury hotel room, there are going to be fewer places available for it. So you might expect profits to go up for that reason as well. So in the short run, investors may receive, so how about investors? Suppose instead of owning this hotel, you get some investors to buy shares in it. Would they be willing to pay anything for a hotel that's going to be destroyed? Then why not? You're going to get profits in the meantime. You just don't know how long you're going to get those profits. And so you might pay some amount and so you ask your finance professor, well, how much should you pay for a share in a hotel like this? And the answer he'll give you, I think, would be essentially the present discounted value of the future cash flows over the life of the investment. But of course, we don't know what the life of the investment is exactly, so it'll be some expected life of the investment, and there's probably a risk premium on top of that. But investors, or a risk premium subtracted from that because the investor is taking the risk, so they would pay less for it. So you would expect investors to be willing to pay something for this hotel. Not as much as replacing it, but something. And it's because of the stranded asset nature of this hotel. It's an asset which is going to be stranded by this change in the sea level. The owner is not going to get everything back, but that doesn't mean that an investor wouldn't find value in investing in it. I'm going to give this a name, and I'm going to call it termination risk. So this is a risk of something in the future. We don't know exactly when it is, but I'm going to call it termination risk. And what I expect is that when you face termination risk, you might reduce investment, certainly investment which has a long payoff period. You might not increase the size of your hotel even if demand goes up, or at least not for very much, because you don't really have a long period of getting revenue from it. And investors would be willing to pay for this stock some amount of money, even though it's not going to pay anything for the long run. It's only going to pay for the short run, but that's still valuable. So finance has a lot of answers to what might happen if you face termination risk. In fact, one of the things that I sort of now think we should mention is that if there are a bunch of hotels on this beach, they're all facing the same risk. If they consolidate so that they only have one owner, then they actually could extract a little more monopoly profit out of this and probably reduce their costs. So you might expect to see some consolidation of these hotels that are facing this kind of termination risk. So why am I doing this in a lecture about climate change? Well, because I think that fossil energy companies are facing termination risk, and we're seeing a lot of things that they're doing which may be interpreted in terms of termination risk. Sounds pretty bad, doesn't it? Termination risk. Well, let's see what they're doing and how it's working out. So one of the things that fossil energy companies might look at would be the IEA, International Energy Administration model, for how we're going to get to net zero emissions by 2050. That's what the Paris Accord asked all nations to predict. We agreed we were going to get to net zero by 2050. And so what's it look like? Well, here's the amount of coal generated electricity and natural gas, and then a few other things. Oil and stuff is in green, and you can see it goes down to zero. So if I'm the CEO of this fossil energy company, I say, it doesn't really look like a growth path, does it? But I might be pretty pessimistic as to whether we'll actually achieve this, but I have to keep it in mind. But the other side of it, of course, is we need to see all this growth in renewable energy. Otherwise, we're going to run out. So these two graphs go together, and they make every CEO of a fossil energy company think about what should I be doing. And this is what they are doing. This is what the graph shows. Renewable energy is green at the bottom, and you can see it's rising, but not nearly enough. It doesn't look like that graph, one piece. If you look at nuclear electric power, which is rising a little faster, but now is flattened out because we've decided to decommission a lot of our nukes, that's not really going to help. The good news here is if you can find the coal graph, it's the one that's declining at the end. That's very good news from an environmental point of view. It does suggest that the coal industry is really headed for zero, and it looks like it would hit zero if this thing gets extrapolated in time. But natural gas and crude oil are still rising. So now I'm the CEO, and I've got to think about how on earth is the government going to get us to do what that picture shows? How are we going to get there? So there are really 4 types of strategies that the government has available for this. You can tax carbon emissions. This is what economists think is the best way to deal with an externality, and this is an externality. A second way is to subsidize renewable energy. That helps the red curve go up. It would make renewable energy available and inexpensive, and that might be what causes the fossil energy company to fail. It might be you would regulate emissions. That is, California, for example, said you can't sell gasoline cars after 2030. Well, that's a regulation. We have lots of regulations. You can regulate what power companies can do, regulate this. Maybe the federal government will say you can't emit more than blank in 10 years, and it would happen. But there's also this last one. The federal government or any of these governments could exercise hope. That is, they could hope that consumers, employees, investors, and corporations will voluntarily adopt greener behavior. So that's for us. Whether we're investors, consumers, employees, or corporate CEOs, are we going to do this? And is this the strategy? Well, most governments around the world have some mix of these kinds of policies, and probably all of them have the bottom one as part of their agenda, because that's what you do before you've gotten started. You know, as a CEO, you probably say to yourself, there's no way the US is going to pass a carbon tax, so maybe I don't have to worry about this. But of course, they are subsidizing renewable energy, and we're getting a lot of solar and wind built. But suppose things get really bad. We get these heat waves that are just devastating, and storms which are devastating. Things could change politically. And that is something that the CEO's got to keep in his head. Okay. So for any one of these, or any set of these reasons, I think fossil energy CEOs are probably thinking about this. And this is what we call transition risk, because it's a transition from the economy we're used to an economy which doesn't burn fuel, fossil energy. It's a decarbonization of the economy, and when that happens, there are many companies that are going to face increasing costs and potentially termination. Okay, so I've now introduced termination risk. What do we do with it? Well, let's look at what asset pricing theory tells us. Asset pricing theory tells us that stocks which face long-run risks are less desirable than stocks that don't. So they should sell for a lower price. And when the price is lower, then actually the returns are higher relative to the price. So stocks that face termination risk should pay a risk premium. And that means that you make more money holding these if you're exposed to this risk. So you might say, well, let's all buy fossil energy stocks so we can take home this risk premium. But of course, another strategy is to say, well, I think things are actually going to get worse than what they were before, so I might want to hedge this risk. I might want to take a short position in these energy stocks so that when the market gets bad, when climate gets worse than it is, these stocks will go down in value and my short will increase in value, and take a long position in companies which are prepared for climate change. So a hedge portfolio is a natural strategy for investors who want to either reduce their climate risk or who believe that the market underprices climate risk. And so we're going to be talking about how do you construct hedge portfolios, how do they behave. I'm going to call them sustainability portfolios, and how have they performed? Constructing climate hedge portfolios on a family vacation. Okay, how do we do this? What we want to do is find a portfolio which is overweight stocks which are prepared for climate change, and underweight stocks that are going to do badly in climate change. And there are basically many ways of doing this. We can use firm characteristics. This is where ESG comes in, the famous or infamous ESG, which has characteristics of what makes firms, what they do. But also just things like what sector are they in, where are they located. A lot of things are relevant for how you would think of who the winners and losers are going to be from climate change. And this is not an easy problem, and it's silly to think that there's an easy solution like using ESG to do it. We ought to expect it's complicated because you're trying to predict a very complicated thing, which is decarbonization using these four political tools, and what's going to happen. Okay. In addition, there are statistical tools for doing this. And the statistical tools have a little bit of a different flavor to them. They say, when there is new information that the climate is bad, which stocks go up and which stocks go down? That's a question of how does the investment world treat news about climate change? So we have these two strategies for it, and I'm going to show you two examples of hedge portfolios that we'll use for the rest of the talk. So the first one is called a stranded asset hedge portfolio. It's composed of 3 exchange-traded funds. It's long the spider, short 70% of a coal exchange-traded fund, and 30% of the broad energy ETF. So this is a portfolio which is short fossil energy. So it's an example of a hedge portfolio which thinks that if you look at the fossil energy companies and just in which sectors they're in, that's enough to tell you how who's going to be exposed to climate change. This was proposed by Bob Litterman at Kepos Capital and head of the CFTC Climate Advisory Committee, and a very respected econometrician and finance scholar and practitioner, actually. And he designed this portfolio for the World Wildlife Association, and it has been very effective for them. But there are many others that are publicly available, and the second one I'm going to talk about here is designed to figure out, with many, many possible sustainable portfolios, how you put the best of them into a portfolio which has actually better properties than the average of them. So how do you form a fund of funds from all these sustainable funds? And we call this a climate-efficient factor-mimicking portfolio. And what we want is this to be a portfolio which is dynamic, it's changing over time, it's long only, you're only going to take long positions in these funds, it's minimizing the variance of the constructed portfolio and maximizes the correlation of this portfolio with climate news after taking out the effect of standard investment factors and taking out the effect of the stranded asset portfolio that's up at the top. Okay, so we're trying to take advantage of this climate news part. Okay? So we're going to do this calculation using a year's data. We're going to hold the portfolio, form the best portfolio we can. We're going to hold that portfolio for a month, and then we'll do it again, recalculate. And this is all posted on VLab. So you can see what this portfolio holds today. You can see what it held 10 years ago, and its performance is there. So one of the things about this is we wrote the code to do this, I don't know, a couple of years ago, and it just runs. So we don't fiddle with it. And this is, so we talk about out-of-sample experiments. This is really out of sample. It's out of sample because not only did I hold a piece of data aside and I only peeked at it once or twice, it hadn't even happened yet. Okay, so you know, I said sometimes I give talks which are very complicated, so this is probably an example of it. What we want to find is the portfolio weights, and what we're going to use as inputs to that. Let's see if this thing works. In the green box, we're going to regress each fund's return on the news, climate news, and on standard risk factors, which are like the Fama-French factors and so forth. Then we're going to minimize the variance of it and maximize the correlation with the betas from the climate news, and that is a nonlinear solution, so we do that. Okay. Well, I mean, there are fairly some things going on here which don't meet the eye, but we're trying to find a covariance matrix of all these funds when, in fact, we're using a pretty short sample. You have to do a lot of shrinking to make this sensible, and one of our co-authors has actually written a new paper, but it's in a tradition of how do you best shrink a covariance matrix to make it look kind of like a better representation of what the data really is. Then, of course, we have to decide whether 1 year is the right amount of time, whether you can hold it for a whole month or something like that. There's some tuning parameters, and we did all those things at the beginning, and now it's just running. Okay, these are the other control variables we've got in there, and these are the other tuning parameters. And for those of you who are interested, there is a paper which is actually forthcoming in the Financial Analyst Journal. This is kind of an interesting problem because it's a very real problem. It's a real problem that investors face and asset managers face because they're always trying to figure out what's the strategy I should use for a sustainable portfolio. And now the answer is you've got to have stocks in there that respond to climate news that we haven't seen yet. So let's go to VLab. This is the web address, but if you don't have a photographic memory or whatever, you can Google it. And here's what this climate efficient factor mimicking portfolio actually looks like. The top three are November, December, and January of this year. And you see it holds mostly either 2 or 3 funds is all. It's not a wide diversity of funds. It's just a small number, so it's actually pretty easy to manage. And this is what it looked like a year ago at the bottom line. So if you look at these things, one question that we get asked all the time is this a physical risk portfolio? We're holding the transition risk fixed. So we're controlling for transition risk with the stranded asset portfolio. Maybe this is picking up the physical risk. And I believe if there were good physical risk portfolios in this universe, we might get them. But there's no in our entire universe of 200 funds that we follow, there's nothing, not one of them has the word physical in the title. Now, they may have it somewhere in the abstract, I'm not sure. But in any case, these things, I mean, the California Carbon Allowance Strategy, uranium and nuclear energy ETF, you know, these are not names that you would give to a physical risk portfolio. So how do these hedge portfolios work overall? So one of the things we'd like to think is that out of sample, and the CEP is all out of sample because everything is just the last month, how do they do? So in the upper left-hand box, you see the long-run performance of these hedge portfolios, and you can see that they have mostly reasonable return, except for the one that only uses the XLE. It doesn't use the coal ETF in there. So the XLE itself has actually, wasn't smart to short the XLE the whole time with one-for-one weight with the S&P. But all the others have positive returns. They have decent Sharpe ratios. If you look at the most recent data, you can see actually they've done terrifically well in the year ending this week. The stranded asset portfolio has 38% return. The climate efficient portfolio only 11%, and Sharpe ratios, which are very high. But if you looked at the same thing last spring, they're all negative. So this is kind of the stylized fact that I want to focus on, is why did these funds do badly last year, but they're doing well this year? Can we understand that better? Okay, so what are we going to use these climate hedge factors for? Well, we're going to use them. You could use them just to invest in directly. Or you could invest in portfolios that are highly correlated with them. You can use it as a test for greenwashing. In other words, when you look at individual stocks, you can ask, are they correlated with these hedge portfolios? They should be, once you've controlled for stuff. And if not, then maybe the stocks just aren't green, or there maybe is greenwashing. And the same thing we can do for banks. And the question for banks is a question, are they holding stocks which are going to be adversely affected by climate change? In which case, it might be that when we have a climate crisis, it will produce a financial crisis automatically. And wouldn't that be a double whammy? You wouldn't want that to be the case. So regulators are worried about that. So when we look at our funds, and as I said, we have about 200 of them, these are funds listed on the left-hand side. We have them by return, volatility, and Sharpe ratio. Then we've got two other things, which is their correlation with news series. Then we have a CAPM alpha, which is basically the regression just on a market return. And then we have the regression that regresses them on the stranded asset portfolio, the CEP, from the French factors, and I guess oil, a return on oil. And so these last two columns, and you can sort on any of these columns, these last two columns reflect funds which are correlated with one or the other of our climate hedge portfolios. And you can see I've sorted here on the very last one, but I could sort on any of these variables. And you can do this yourself. Just when you're in VLab, you can just click on any of these down buttons and you'll get the sort. And you can see here's solar fund turns out to be the best one from the point of view of the CEP, but and that's over a 5-year performance period. And then here are some others that are sort of close behind it. Okay, so this is an example of what you can use these hedge portfolios for. And what about for individual stocks? Well, we do the same thing for individual stocks. We regress, I guess in this case, we're creating a couple more hedge portfolios, which are emissions-based hedge portfolios, but I'm not going to talk about that. So for all the stocks on the S&P, we regress them on the same factors, and then we put in now actually 4 climate hedge portfolios, and we ask whether some of them are significant or whether others are significant, or in fact whether the sum of the betas is actually positive, which is kind of what you'd really like to know. So we've got ranking of the greenest stocks on the left and the least green on the right out of our 620 stocks that have been in the S&P over the last 20 years. And if you look at the right first, you can see all these energy companies, fossil energy companies, are very high on the brownness scale. If you ask which of the rest of the S&P are the greenest, that's what's on the left-hand side. And I'm not sure whether you get a lot out of that, but one of the things I think is that the companies that are most exposed to transition risk are not a big fraction of the S&P. We've got all the tech stocks and service stocks and all that sort of thing are kind of low emitters. And ranking them is a little hard to do with this technique, I think. Okay, now we're going to do the same thing for banks. Okay, and we use a little different estimation method. You mentioned the Arch-Garch models. Well, one of the things you can do is you can estimate a model where instead of using the average volatility and the average correlation, you can use today's volatility and correlation forecast for tomorrow to get tomorrow's beta, and then you update the volatilities and correlations and estimate the next beta. We call this dynamic conditional beta. And if you've seen the dynamic conditional correlation, which we talked a little bit about, this is the next step. This is doing the same thing for a whole regression. So we're doing that for bank stocks, and we're going to run this regression with a market beta and a climate beta. And here's what we see for Citibank, for example. This is the climate beta for Citibank over the last, I think, 5 years. So what you see is it wasn't very big in 2019, but it went up quite substantially in 2020 and 2021. And this is typical of many of these stocks, that the pandemic was a time that looks a lot like decarbonization. We stopped driving, we stopped flying, we used technology, Zoomed all our meetings instead of going in person, and that put tremendous pressure on the fossil energy sector because their demand dropped like a stone. So if you want to know what some of the effects of radical decarbonization are, I think that's kind of what you see. And so here you see that the climate beta went up substantially for Citi because presumably it had a fair amount of of fossil energy related loans that it had made over the years. It then came back down again, but the interesting thing is what's happening at the right side is it's going back up again. And we don't know exactly what's happening. What we have done is take a look at what the actual holdings are of Citibank and 1,000 other, well, no. All the US banks, we can see that because one of our co-authors is a member of the Fed and can see the Y14 data, which is very convenient. We can't see it, but she can. And so we're looking at what's happening here. But this is an example of paying attention to what's going on. Okay, so why were the sustainable funds and benchmarks so bad last year? Well, we asked our friendly emperor, and here's his answer. Everything is proceeding as I have foreseen. And the question is, do we foresee this? Well, most sustainable funds were underperformed last year, but that's not very surprising because they're mostly underweighting fossil energy, and fossil energy outperformed. So by just mechanically, they're going to underperform. But why did energy outperform last year? And I think the answer that I'm interested in is that termination risk became sufficiently important that they stopped investing as much and they reduced their supply of energy so that the prices went up. So energy prices went up, energy stock values went up, and the number of drilling rigs went down. So that's a sort of an ad hoc story. Well, what else do we see here? Well, one of the things we're seeing is consolidation in the energy sector. You've seen these big mergers, but Exxon and Chevron and a couple of the frackers have all been buying their competitors. So people say, yes, but the energy sector is expanding. But the answer is no, it's not expanding. Some of them are selling themselves to the others. So it's the same amount of energy production, and it might be managed better. And I think it's consolidation in this sector is actually going to lead to a little more monopoly power that the energy sector is going to have. Because the frackers are sort of an independent group, and they really didn't do always what was best for the Chevrons and the Exxons of the world. Okay, so why did energy stocks do well, but the sustainable index didn't? Well, the sustainable funds index really is designed to mimic what happens with a carbon tax. If there were a carbon tax, then all those high prices of energy would have led to high tax revenues for the government, but not high stock prices for the energy company. So we sort of missed that opportunity by doing too much of the hope stuff. It might not be too late, but I think that's the reason that the sustainable funds went down when energy prices and energy stocks went up. So what's the empirical evidence for this kind of termination risk? Well, I'm going to show you PE ratios. So these are the ratios of prices to earnings. And I'm going to show you that, and I'm going to show you price to book ratios. So price to book ratios are the ratio of the stock price to the book value of net income, net worth. And in the case of the book value, all these stranded assets and long-term loans and so forth, which maybe have less value now than they used to, like the hotel, are still typically held at full value on the book. And so the price falls relative to the book value, and investors think this is a great bargain, but it's really that the book value is not reflective of market values. And so here is the price-earnings ratio by sector. See, real estate is the top, energy is the bottom. This is for 2021 and 2020. So energy is the lowest. Here's the price to book ratio for the same sectors, and again, energy is the lowest. Here is a plot that I pulled out a day or two ago for January 24th, which has lots of different ways of calculating price-earnings ratios. And if you look at the circled number at the top there, it says 8.38, says that the average price-earnings ratio in the energy sector is 8.38. And we can interpret that roughly as 8 years. Termination risk to the stock market investors looks like it's something like 8 years for energy sectors. What's it look like for technology? 38 years. And if you look down the column, you see that, again, they're just rising and rising and rising. So tech has a much longer horizon than energy does. And this is a question of what do investors think fossil energy stocks are really worth. So another piece of information in this table is the green circle. Earnings per share of the last 5 years increased by 26%. It's the highest sector. So that's the best earnings growth of all sectors over the last 5 years. Its forecast over the next 5 years is to be increasing at 1%. So it's done the best, and it's expected to do the worst. It's done the best, but the stock market didn't give it much valuation for that. The prices went up, but not so much for the amazing amount of growth of earnings. If you look at the same thing within the energy sector, you see that thermal coal is the worst. It's got the lowest PE. It's 4.3 years. The highest is uranium with 81 years, but when you strip out the nuclear, you see the various other components of the energy sector. Okay. All right, so now I want you to think big for just, I don't know, 2 minutes more. Think big for 2 minutes more. Countries also face termination risk. Countries that have a big fossil energy sector are worried about what's going to happen to their economy. When the biggest industry is facing termination risk, your country's in trouble. So if you look at the Middle East, the Middle Eastern oil powerhouses are all investing in different things. And we see them in sports teams, in tourism, in airlines, all sorts of things that they're doing. They do it very well. They spend a lot of money. They're planning for the end of their oil revenue. So again, this looks like a real thing. How about Russia? What's Russia's plan? Russia also is very dependent on the oil industry. Well, I think it wanted to diversify its economy too. It's just they did it by trying to invade Ukraine and get a more agricultural productivity and a thriving economy, Ukraine. And I think that Putin really sees termination risk as a real thing. He couldn't wait to do this because in 10 years, his oil business will not be as strong as it is now, and Europe will be better able to survive without Russian gas because they have a whole lot more renewable energy. So he had lots of incentives to do it and to do it now. And so basically, this is a lot of energy pulled off the market. And this is exactly what, again, you'd expect to do when you have a termination risk. You'd expect to reduce the supply and let the price go up. So are we happy about this or sad about it all? I mean, if you're an environmental or a tree hugger or something like that, which I suppose I am, is this all bad news or is this good news? And basically, it's always been clear that high energy prices are going to be a part of decarbonization, because how do we get consumers to stop buying things that have a lot of carbon input? Well, you make the price high. I mean, you can ask them voluntarily to stop eating meat, but it's much more effective if meat gets more expensive. And the same thing for gasoline. I mean, it's a burden for many people, but when gasoline gets expensive, we saw lots of people buying Teslas, and they didn't drive as much. And this is exactly how this is all supposed to happen. The hard part about it is that the profits went to investors, not to the government. If the profits had gone to the government, we'd be all saying, you know, we really nailed it, but we missed that. So high energy prices are a part of decarbonization, and we shouldn't be unhappy about that. If we'd had a carbon tax, we'd be even happier. We could do something about climate justice. We'd be able to use the revenue from the carbon tax to help people that were really having financial difficulties meeting the new high energy prices. We didn't do that. So do we still think a hedge portfolio is an interesting thing to invest in? Yes, I think so, because if termination risk is uncertain and is potentially sometimes longer and sometimes shorter, then it's still true that when the termination risk moves further into the future, energy stocks are going to go up. And when it becomes shorter, energy stocks are going to go down. And so it just changing the way you say this, but you again want to be short. When termination risk gets sooner, that means the climate's getting worse. You get sooner, and the price of energy stocks is going to go down. You wanted to be short those. So it's still, I think, a good hedge. It's just that it's had a bad year. And looking at the data, we see that this year actually seems to be much better. So what about termination risk, not just for countries, but for the planet? Well, we have to think about that. Termination risk for the planet is the ultimate termination risk. This is the end of the species as we know it, and we can't diversify. We could reduce investment, but it just doesn't seem like the right strategy. The right strategy is to stop climate change. The right strategy is to exercise these policies which are designed to mitigate climate change, and since it's a global problem, somehow get all the countries of the world to do the same kind of thing. It's nearly impossible to imagine that all these countries are going to fall in line, but my belief is that if the largest emitters really have a serious policy and reduce their exposure and are going to meet their net zero targets, the smaller emitters, many of them will follow, and the few that don't follow are small, so that it isn't going to be that big a deal. So what's most important is that the US does our share, that Europe does its share, that China does its share, and maybe India. Those four are really the key to getting this job done. And I think actually the US might be the hardest sell. We're not really on our trajectory. And China has the advantage that they can turn off switches of things, you know. And they are actually pretty motivated in many ways different from what we might think. But in any case, there's a whole conversation we could have about that. But in any case, I think there's a chance China can be doing it. and we need to make sure we do it. So here are 3 of my grandsons who wonder whether we're going to get it done or not, and what kind of a world they are going to inherit. And if we can tell them we have it solved, they'll be a whole lot happier. So, thank you.
I think I'm going to go see the Terminator tonight. That's so. Please be patient with us. There's a lot of questions. Some of them from you guys, but some of this is the fun stuff, less technical. You pick your seat, and yes. And so thank you. That was a great talk, and I like. Sorry.
No martinis? Oh.
No. That was a great talk, and I like some of the stuff you're doing, and I'll give you my card if you need a co-author. I'd also, some of the PB and P ratio stuff, I'd love to hear later Jeff's take on that, but that'll be separately, but I'd love to hear Jeff. I'm sure he has a whole deep interpretation of that, so I'd love to hear that. Some of the questions that I had sent you, so a lot of these questions I sent our guest speaker in advance, you've answered a little bit, so I might skip those. And I also want to tell everyone that I love the environment, but I'm going to play a little devil's advocate for a few questions. So let's start. You mentioned these issues with termination risk, but if the risk is so far in the future, might it not be better just buy oil companies now and we'll either make money or won't make money depending on things like government? For example, if Trump gets elected, it's going to change the whole oil dynamic. So that's a question. Is it okay to ignore this because in the short run, it won't matter much?
Well, you're talking about market timing. So the question is market timing a sensible thing to do in light of termination risk? We don't think it's necessarily a very smart thing in terms of ordinary investment, but who are you going to sell these oil stocks to? I mean, if Trump is elected, they'll go up in value. If Biden's reelected, they'll go down in value. Mm-hmm. So it's a hedge, but it's the wrong side of a hedge. It's not necessarily the wrong side of a hedge, but you're hedging the election, you're not hedging climate, mm-hmm. and it isn't clear that there's easy money in doing that, and it's got nothing to do with termination risk.
Okay, fair enough. You speak about stranded assets, and so here's an interesting thing. I could be wrong about this, but it looks like people are moving to Florida in droves, and the rich are buying, houses right on the cliffs, and so you might argue that it's actually limited supply. But my question is it that these people just don't believe climate risk, or is it something else? What is going on? Why are people buying houses in Florida on the water?
And condominiums and big high rises and stuff like that right on the beach. I think it's crazy, first of all. And I had a big fight with a friend about this who is a Florida real estate guy. He says, people just don't pay any attention to it. And I'm saying, but insurance premiums are going up like crazy. Insurance companies are pulling out. Why are they pulling out? Because they can't raise prices fast enough because the insurance regulator won't let them do it. So this is not a fact that corporations are ignoring. It's a fact that Florida residents are apparently ignoring. And it may be that they are uninformed. I think there is a view that building requirements have tightened, and so the old condominiums that fell down were just flawed, and these new ones are going to be able to withstand the high seas. High seas are pretty devastating, and I think that I think what we're going to see, and I don't know whether I want you to remember this or not, depends on whether that happens, but we'll see some big storm come in and destroy a lot of Florida property, and the insurers that are still in there are small and not well capitalized. They may have some reinsurance, but I don't know whether they have enough. And so they will go bankrupt, and it will be thrown to the state-backed system, which is completely undercapitalized, and it will go. The taxpayers have to pay it. And so the taxpayers in Florida are actually bearing the burden for all these people in these condominiums. And I think it's going to be a big disaster.
Okay, thank you. Let's see, the next question. In the end, we're economists, and fossil fuels have some expiration date. Although in the meantime, gas prices go up. So have economists, I know it's not your work, but just have economists looked at the welfare now versus later? In other words, are they considering all the costs? The fact that most poor people, and even middle class, and even probably higher than that, are getting hit by higher gas prices now, and versus, you know, what happens in the future?
Right. So we call this climate justice, and economists are worried about that. It's quite clear that low-income people spend a higher share of their budget on gasoline than high-income people. And so they're more hit by this. So how do we think about that? It's really unfair for them to be the ones that have to economize, but they are the ones that are motivated to economize. Because I think low-income people are more likely to switch to the bus than high-income people are, if they're assuming there's a bus. But it might not be fair. So public policy can do something about that without changing the relative price. You can give a supplement to low-income households, which is supposed to compensate them for the cost of their higher gasoline. California did that, actually. We had such a budget surplus that there was a per capita allocation to every family in California, which was supposed to help with the high cost of gasoline. Now, did we use it for the gasoline? No, but it ameliorates this idea, and by doing it on a per capita basis, it's a very nicely regressive, or I guess, anyway, it helps poor people a lot more than the wealthy people.
Okay, so similar, you also had a slide, the carbon tax could be used in theory. Okay, another question. The past is littered with doomsday prophecies. Probably the most famous economists are aware of is Thomas Malthus in 1798 said, "We'll die, we're all going to starve and die because there won't be enough food." In the 80s, there was the big ozone depletion comment. Can we learn or apply anything from these past issues? And are economists considering that humans do change? I know you had a slide where it says hope, but that society has changed. The case of Malthus is a great example. We didn't starve. We're actually all eating pretty well. Maybe the GMOs are a little annoying. Is there,
Yeah, I mean, there is this comment that the Stone Age didn't end because we ran out of stones. And the question is, do we adjust? I mean, you know, I can tell you a lot of my interpretation of what you said, but I think the physics of climate change is very, very obvious, because when there's a conservation of energy, which is happening, that more energy is coming to the planet than is leaving the planet, and so it has to get warmer. It's going to get warmer and warmer. Now, the question of what we do about that is, you know, the question of whether we can avoid this trap or not, and that's exactly my point, which is when it gets really bad, we are going to go to measures which are more draconian than anything we have ever seen before if it gets that bad. Now, you might also say technology is going to save our skins the way sort of it did with efficiency of agriculture in Malthus. And I'm delighted if that's true. You know, a lot of people are studying these geoengineering models. There's not a lot of hope for them. from what I hear. And there are a lot of concerns that they can be misused. So I don't know. It just seems to me we should be doing everything we can in a sort of a reasonable, managed, orderly way. And then if technology suddenly solves this problem, we should have a big party.
Big party, okay. So one other related to all this, a lot of people who, I don't want to say are against climate change, but people who are skeptics, they argue strongly for mitigation rather than prevention. And so I wanted to know your thoughts on that.
So I'd like to suggest use a different word. Okay. Adaptation is the word you mean, okay, rather than mitigation. Okay, because we're using the word mitigation almost exclusively to talk about stopping climate change, and adaptation is adjusting to what seems inevitable.
So my question was, lots of the discussion is on prevention or mitigation, as you use the word. Right. What about building things that allow us to live in a world that gets hotter and blah, blah, blah?
There's every reason why we should adapt. Some adaptation actually also produces mitigation. Some adaptation actually makes it worse. Air conditioners make it worse. Building insulation does two jobs. So it's a no-brainer that you ought to adapt to it. And most of the investment stuff that I'm talking about here is better interpreted as adaptation than as mitigation. Investors take the world the way it is and try to figure out how to do the best job they can of investing. So that's really adaptation. And it's really up to the government and their four flaky policies to try to steer that into mitigation.
Okay, thank you. I'll come back. I still have some more on that, but I'll come back because I think the audience wants some more of these lighthearted questions, some of them. Okay, so you're an economist. What is the biggest lesson you have learned in your career about economics?
Economics keeps changing, and it changes because of events. And so I think we have to, sounds silly to say, pay attention. Pay attention to what's going on. Pay attention. This whole talk is based around noticing that energy prices went up when they're supposed to go down. They didn't do it. Why not? And you think about why not, and all of a sudden you get a sort of an idea of something that can explain that, and then you say, well, does it explain anything else? And so paying attention to what's going on around you is totally interesting and important.
Okay, thank you. AI is becoming everywhere. We see AI, even though it's existed for a long time. So the question is, how will AI change investing in economics?
So I get asked that question a lot too, and my answer might surprise you. I don't think it's going to have much impact at all. I think that AI is extremely effective at solving problems that we've not really analyzed very much before, where we don't know what the right specifications are, we don't know how to build a model, we don't have really great data or something like that. Investing and forecasting the stock market is something we spent zillions of dollars trying to do that. We had so many smart people from all over the world have been trying to do that. And of course, you only have to, it isn't a question whether you can forecast the stock market. It's a question whether you can forecast it better than everybody else that's trying. And that is a totally impossible task. So I don't think we're going to see much difference in ability to forecast the stock market. Maybe we'll see more difference in sort of portfolio construction, or maybe in the back office management. I think we'll see a lot of a difference in accounting and things like that, which are very amenable to this.
Okay, thank you. During the Corona crisis, which, for those who don't know, you were scheduled to come, and then came the Corona crisis. So we had to cancel everything. And so you've spent a lot of work on risk management and financial crises. And the Corona crisis turned out to be a point where it was one of the best times to invest, March 20. How do you know, or what tools do we have? You just said we don't predict very well, so maybe the answer is we don't. What tools do we have to know when it's a great time to invest in a panic and when actually you should stay away?
So when you said March 20, I thought you meant the March 20th.
No, I meant March 2020.
Not March 1st of 2020.
No.
That would have been disaster, right?
Right, yeah.
Okay, so the question is, what moves the stock market? I mean, I'm not really going to answer your question. What moves the stock market is new information. And we see this new information. This is already what I talked about, but we try to forecast what's going to happen next. A panic is where you see new information and you say, oh my God, that means that this forecast is going to be just devastating, so I better get out now. So we all have different forecasts. And so some people come up with a panic forecast, and other people say, well, you know, I'm going to try to figure out what it does to these different industries, and that's going to tell me how it's going to go down. Other people say, you know, it's going down, but really I think the Fed's going to do something about it, so we've got a floor out there that's going to protect us. Those were the people that were right, that said, well, the Fed's actually going to stop this, and the Feds also. And so, you know, I don't think there's any way of knowing whose forecast is right ex ante, but ex post there certainly is.
Okay, I'm going to say something funny about this. During that time, I was buying like crazy after it dropped. And I'm not going to say who, but I called a friend of yours. And I asked him, should I be buying? And he said the following. He said, in other times like this, it was a good time to buy. So I kept buying, but we'll talk about that later. So let's get to something about your Nobel Prize. I think people are curious about this. You won the Nobel Prize for your development of the Arch model in 1982. Your student, I mentioned, developed GARCH along with you and then other models. Can you talk us through what gave you the idea to even work on that model? And what you think the real contribution has been to economics and finance?
So you'll notice when he read the wonderfully clear title of that paper that it's about prices. It's a question of what's happened to the volatility of prices. And Milton Friedman, who was one of the greatest economists of all times, has had, when he got the Nobel Prize, wrote a lecture which he said one of the causes of business cycles that he thought was particularly important was uncertainty about future prices. He thought that if future prices were uncertain, investors would stop investing and the economy would have a deficient demand and would spiral downward. So I thought, you know, I'm going to try to estimate that. And how do you measure uncertainty? Well, variance is one way to measure it, but variance is just a number. And that was the breakthrough when I realized variance could depend on what you had seen so far rather than just being a number that you calculate. So variance became a process. And that's what I call the conditional variance. So it says, and this is what we all do logically, we want to know what's going to happen tomorrow, and this is what I know today. So we're doing conditional forecasts, but we really didn't ever know how to do a conditional forecast of risk or variance, and that's what this method showed. So what's the enduring consequence of that?
What do you think the biggest contribution has been?
So I think that really the contribution was not the particular model that I wrote down, but it was really a class of models that enable you to try to figure out what it is that makes markets more volatile or less volatile, and frame that question as an empirical question that wasn't there before. And of course, as soon as you've talked about the variance of one asset, then we have two assets, we have a correlation, we have 100 assets, we've got a covariance matrix, you know, and we have extremes, so we have extreme values, and we have extreme values of portfolio. So once you start down this road, there's a lot of stuff that is useful for measuring risk. And I think really the main tool is that this gives you a way of measuring a particular kind of risk.
At the time that you wrote this paper, did you have any clue that it would become such a big deal?
No. Basically, I knew that it was a good idea. It was kind of clever. And I was living in London at the time. I talked to a bunch of my friends. David Hendry, I spent a lot of time talking with him. And they all thought, yeah, this is cute. This is cute. And the thing that is cute about it is you can take a time series model, which we estimate with ordinary least squares or something like that. And if the residuals in this model have the kind of arc structure that they very commonly do, you can actually improve the efficiency of this model by doing what is essentially weighted least squares. So that's the cute part of it. What I actually thought might be more interesting, and turned out to be, was the actual estimates of the volatility were interesting, not just the correction you did for another model. And so when I started doing this, finance people got very interested in it. They continually invited me into meetings and consulting contracts and all sorts of stuff like that, where the key issue was, what's the volatility going to be in the future? And do I get rewarded for holding volatility in all circumstances or only in some? And, you know, how do we do all this?
Okay, so when I first started on Wall Street, I built a Garch model. And the idea was to improve the asset allocation by, instead of using historical volatility, I'd use Garch. Turned out, didn't improve anything. So the question I have for you is, does Garch really help predict future volatility, or is it limited to certain time horizons?
Okay, so I saw that question. I was thinking about, what am I going to say about this question?
Yeah.
I could say, you probably use the wrong model. But I think there's a deeper point I want to make, that asset allocation is a trade-off between risk and return. And people spend a lot of time trying to measure return. And I would say the finance literature believes that the only return you can measure is the average return over a long time period. Well, if the volatility is changing and return is not, that doesn't make any sense, because what really is happening as volatility is changing is the return is changing, and you just don't know it. And so when you do your asset allocation, if you're using sort of Markowitz or something like that, you need to have a number for return as well as for volatility. And that doesn't work very well. And for a simple example of that is, if you look at what is now called the Garchian mean model, where you look at what the expected return on a stock is, given the volatility of it. Well, it turns out when the volatility is higher, the expected return is higher. There's an intercept in that equation, but the intercept is not the only thing that's there. The volatility is also there. So it tells you that when the risk goes up, the return actually goes up. And when you ask, what do investors do when there's news that the risk is going up? They either sell their stock, which makes the price go down, and then at this new level, the expected return is high enough so that they're willing to hold the set of stocks. Or, well, I mean, I guess that's basically what they do, or else the market just falls without them having to sell, because they know that when volatility goes up, the market goes down. We know that too.
Can I ask, just follow up on that? If you had to give someone, for example, this is the best way to use Garch. I'll give you some examples. To estimate tomorrow's volatility instead of like 30 days from now, or some other variant, is there one that comes to your mind, or is that too vague of a question?
Well, Garch is better at short-run forecasts than long-run forecasts. That's been shown many ways and many times. When you use higher frequency data, you get more information, and that's shorter horizon, so that also helps short-run forecasts. I think the most useful thing for Garch is predicting risk. And we have to predict risk regardless of whether we can predict return. I mean, because we have to decide over and over and over again, do we want to expose ourselves to this risk, or do we want to get out now? And that is a real question. And if you think about money management, you've got big companies, investment banks, whatever, that have 1,000 traders, and they're all buying and selling assets under the company's name. So how do you avoid them just becoming rogue traders that trade zillions of dollars that the company is going to have to owe? You give them a risk budget. You say there's only a certain amount of risk you can take. And if you manage this money well and you're making money, you get a bigger risk budget. And so it's just part of managing to be able to allocate risk to different people, to different sectors, to different asset classes, to different geographic regions. And we do the same thing for our portfolios. We allocate risk to different sets of portfolios. And so I think that's a really useful tool.
Okay, thank you. We've got two more financial type questions, and then we're going to the really soft, fun and friendly ones. So first question, in the Silk Institute, we're going to be helping with financial literacy for young people. What do you think should be taught to young people about, and also speak closer to the microphone, I just realized we both aren't. What do you think should be taught to young people about investing? And I'm thinking 8 to 14-year-olds, or economics.
So what I did with my grandsons is, when they were around 11, I opened a brokerage account and put $1,000 in it. And then I said, okay, so what should we buy with that? And we talked about it, and we put in Nintendo, I think. We put in, a few things, and Google and Netflix. They all knew Netflix, and then we sort of have another conversation in 6 months or a few months or something like that. And then the next one would turn 11, we do the same. So I now have 3 of these sort of staggered portfolios. The oldest one, who is now just about to go to college, it doubled 1.5 times, something like that. It's 3,000 and something now. The second one has almost caught up. So there's this question about it. What did you invest in? What did I, and blah, blah, blah. And the third one is a long way behind. So it's a question. So in any case, it was very useful to have a real dollar thing. It's their money. I told them it was their money. And it just made them interested in it.
Okay, thank you. Now I'm going to ask your thoughts about certain different people, and please limit it to one sentence and no more. He's not going to answer this, but I'm going to try. Clive Granger.
So I told you I'm not going to answer it, right? He's my colleague and my friend, and he's passed away. And I shared the Nobel Prize with him. He's terrific. He, you know, we did all sorts of things together. The Nobel Committee, and I'm going to just say this now, does not actually think of econometrics as a field. And what they think of is econometrics helps fields do better. And so if the contribution that you've made is a contribution which really improves life or practice for some part of the economy, that's a prize-worthy event. If it's really just improving econometrics, it's not necessarily that way. So we evaluate each other in the econometrics profession rather differently from the way the Nobel Committee does it. And Clive does very well on both measures. That's just why he got the Nobel Prize.
Hal White.
Hal White's more of an econometrician's economist, and he passed away, but he was on the list, I'm sure, for many years.
Jerry Hausman.
Jerry, I'm sure, has been on the list, including when you had him. You know, he's hardworking, does amazing things. I don't think it's going to happen.
Okay. James Stock and Mark Watson.
Stock and Watson, well, Mark is a student, was a student. Actually, he was my first PhD student at San Diego. I mean, I think they've done very well, and they're basically really respected in macroeconomics. And so, I mean, they get invited to Jackson Hole every summer and have done really important work in macroeconometrics. So that's the sort of thing that I think the Nobel Committee does kind of like.
Mm-hmm. Whitney Newey and Kenneth West. That's our last one.
Yeah, you know, they get more citations than almost any econometrician because the Newey-West standard errors are used all the time. But I don't know that the Nobel Committee is going to feel like that's their kind of contribution.
Mm-hmm. Okay, now let's move to personal experiences, and we're almost done. Thanks for your patience. It's one of those things. I could be here all night.
How did you get him to keep sitting such a long time?
Well, I don't know. I'm still trying to figure it out. But there are cell phones nowadays. So how did your life change after winning the Nobel Prize? What is the coolest thing that happened because of it?
Well, you know, when they get ready to hang up the telephone call, the famous telephone call, they say, in 5 minutes we're going to tell the press and your life will never be the same again. And we sort of looked at each other, my wife Marianne here, looked at each other and we said, oh my God, we've had a pretty good life. Does that mean it's going to turn down? But probably the coolest thing that's happened since then was, you know, when I got second place in this figure skating competition, a couple.
And how was the phone call? Who answered the phone?
It came in when I was out, and she answered the phone. She answered the phone, and said, no, he's not here. He's at a computer store or something like that. And this was in the middle of the afternoon because we were in France at the time. And they said, well, just tell him this is an important call from Stockholm. And when I walked in the door, she was white as a sheet. I said, oh my God, what happened? And she said, there was a phone call from Stockholm. And I said, really? And then this is in October, and the way they announce them, as you probably remember, they announce one each day. And economics is the last one, and so it's Tuesday of the second week of Nobel announcements. So I had sort of seen on French TV all this stuff, but as soon as I walked in, and she said this, then the phone rang, and so I got it, and French telecom sounds like something like that, and she was speaking English, but it had some Swedish accent, I guess, and I couldn't understand what it was, but anyway, ultimately, we figured it out and then got this little warning at the end.
Life will change. Okay, great. Who was a mentor of yours, and can you describe the greatest lesson that they taught you, and what are the greatest lessons that you have passed on to your students?
Well, I think of my mentor as being the summer meetings of the Econometric Society in Europe that I would go to every year, and there would be a group of young econometrician, time series econometricians about my age, and this included people, it included Clive, it included David Hendry, it included, Chris Sims, Timo Teresvirta, Sven Hulebed, a whole bunch of people, some of whom you know and some of whom you don't. And each summer we'd give talks on to this Econometric Society about what we'd been working on this year, and then we'd sit around and we'd drink a lot of beer and talk about it, and it was fantastic. You really got a sense how science moves forward. You get an idea, and some ideas just resonated, and other ideas seemed like tiny little things that weren't really that interesting. And so I try to pass that on to my students, that whenever you get stuck, and every research project gets stuck, you're going to run this regression. You've gathered all this data, you run the regression, and it's got the wrong sign. Oh my God, what are you going to do? My answer is, this is when you earn your living. It's when the first thing you try doesn't work. That's when there's something interesting going on. There's something wrong with your theory, something wrong with your data. You've got to think about all the possibilities. 1, 2, 3, 4, 5, 6, 7. What's the data trying to tell me? Is it trying to tell me that I left out something? Is it trying to tell me that my theory has got to be turned on its head? And I love doing that. It's sort of brainstorming when you've got some results and trying to figure out what it is that you learned from them and what to do next. And really, that's where there is the possibility of a great innovation. Because if you can explain what went wrong, sometimes that's really important.
Okay, thank you. What is something that you've learned from a family member that helped you in your career?
Well, I have to say, that's my wife that I'm going to have to refer to, because we talk about lots of things. I mean, I don't really talk about econometrics with her, but we talk about careers, we talk about family, we talk about the importance of so many things. And so the word I like is balance, that I don't think you can be a good academic if you don't have balance between your family and your research career. It's tremendously important, and you have to talk about these things because they're always a point of conflict. And she is always supportive, except when I don't work hard enough at it, and and any success I have, I mean, how many talks have you listened to? I mean, it's really, it's a bit much. And so it's great. I should say one other example I have is that I had an 80th birthday party that they gave for me in China last fall. And I asked her mother, who was a famous author and Auschwitz survivor, I asked her if she had any ideas what I should say to all my friends who were coming to this party from all over, sort of all over the world, but mostly from Asia. And she said something which I think is just really useful to keep in mind. She said, just tell them, keep climbing. Don't stop, just keep climbing.
Not bad. Thank you. So we have 2 more questions. I have much more.
That was a good one to end on.
Sorry, I know it was, but we can always edit the tape. We can edit the tape. We have 2 more. These are 2 I have to get out because they're on every with every speaker. Out of all your accomplishments, what are you most proud of and why?
Didn't you ask me that already? And I said figure skating?
No, I didn't ask you. But is it figure skating? It can be personal too. It could be kids. It can be anything you want it to be.
Well, what am I most proud of? I mean, I've had a lot of wonderful students. I have a wonderful family. I have opportunities to do stuff like this. I can't really say, I can't identify a particular one.
Okay, great. So just a wonderful life in all ways. What 3 pieces of advice would you give to students at USF so that they could be successful in their career and their life?
Well, I think that probably I'm being repetitious, but I think, first of all, you need balance in your life. Second of all, I think you want to be a keen observer of the world around you, at least if you're doing anything like economics that is continually evolving. And 3, I think you should be enthusiastic. I mean, you should love what you're doing and try to make that transfer to other people and to your students and people you interact with, because enthusiasm is really, it's very powerful.
Okay, thank you. Should we stop there? Is everyone ready to stop? Okay. Thank you very much. Dr. Engle, thank you very much.